Hi everyone, welcome to Tuesday, and like normal we always do a review on the NZX 50 and how that's performed over the past week. Now before I do that, I just want to remind you of the second part of our Learning to Invest series, which is on tonight at 7:30. I'll make sure there's a link in the description below. You're not too late to join. It is a $20 investment, but hey, if you want to improve your situation, it does pay to invest in yourself. So what we're going to cover in this is we're going to look at different investment options and which ones may be right for you. We're going to look at active versus passive investing. There's some really great tools that I'm also going to show you in this seminar, which you will obviously be able to have free access to afterward. We will look at investing versus speculating, income versus capital gains, and also managed funds. Managed funds can be a great way for people to get started in investing. And in fact, if you own KiwiSaver, you will have a managed fund. Right, now before I jump across and share my screen, just remember that this is for educational purposes only, definitely not intended to be personalised financial advice. If you're looking for that, you do need to go and have a chat to your own financial advisor. Right, let's take a look. So we've got the S&P NZX 50 being the main board for the New Zealand Stock Exchange up on the screen. And sort of no surprises really. We did have a down week last week. You can see that denoted by that candle. Now, when I look at that candle, let's zoom in on it. You can see that the body of the candle is quite solid, but there is a wick at the top. Now, that potentially does indicate that there's downward pressure on it. So for those that are unfamiliar with candles, where the solid line starts at the top, that is where the market opened last week, and the solid line at the bottom is where the market closed. Now the wick at the top is the trading range. So if I just hover on that, at the left-hand side, you can see that the market opened at 13,617. It had a high of 13,725, a low of 13,464, and that was also the same as the close. So it didn't trade below that. Which you can see the next candle in, which was just the trading on Friday, you can see that there was quite a bit of a tail on that one. So even though the market opened at that solid top line, it closed below it just on Friday. That's denoted by that dashed line as well. But you've got that long tail. So that is actually an upward or positive sign for the market, because it means that there are more buyers in the market than there are sellers. The thing about this candle for last week is if I look down the bottom here, you can see that there was very little volume on the market, and that is actually a really good sign. It means that even though the market was down, and that does happen, I've spoken last week that we've reached an all-time high. It's natural for potentially a market just to come off a little bit before it goes again. And that can be seen here with the low volume that we've had over the last couple of weeks of trading. That could be a positive, but we just want to make sure that time will actually reinforce that. And if I go back out, you can see with our market, we obviously have a bit of a run. It steps back a bit, a little bit of a rally again, a little bit of a sideways, then it's been running again. So it's been very, very slow, but it's almost been methodical, which is really good. Let's put our moving averages on and just take a look and see what that's showing us. Remember, I always use the 30 exponential, and we will also put on the 15-week or 15 period moving average. Again, change that to exponential, change the color, means that we can see it. Right, so the market is trading above both of those, which is a good sign. Obviously, with that close on Friday, it is hitting the faster moving average, being the 15-week, but that's okay. But for me, I just want to pause and hold, and I'm not entering any new positions at this stage because I really want to see what this market is going to do and what potentially is going to drive it. Let's have a look at the 1-year chart. Now, when I look at the 1-year chart, that brings up quite a different picture. If I zoom in here, on the 1-year chart, it brings all these candles up to daily, and you can see that for most of last week, the market is actually trading below both of those moving averages. The 15-day, or the 15 period, so it becomes a 15-day, has got very, very close to that 30. Now, if it continues on this trajectory and it crosses down, that is the sign of a very negative market. Again, only time will tell us what is actually going to happen. So for me, looking at this, for this very reason, we've got the market trading below both of those moving averages. We've had 2 down days in a row last week, being Thursday, Friday. That for me is an automatic stop. I do not want to do any more research or look any further to see if there's any potential possibilities with investing in the market. Like I just said, we need to wait and see what this market is actually going to do. There are potentially opportunities out there, and I have spoken about this before, and that's looking at things like exchange traded funds. I'm quite pro smart shares or ETFs, just for the fact that they are based in New Zealand dollars. So it can take away any potential issues when you're looking at foreign investment fund rules, FIF rules. Remember, you do need to get tax advice when you're looking at investing in anything that could potentially have exposure offshore. But that is something that I do quite like. It just means that because they're donated in New Zealand dollars, they can be a good way to get exposure to other markets away from the New Zealand market, yet it's still based in New Zealand dollars. So I'll just stop sharing. Yes, with Smart Invest, you are paying a little bit extra in management fees. However, that's because it's donated on the New Zealand market. So you've got to take one with the other. Seeking tax advice is a great way to do it, but it's certainly a good way to get exposure to those other markets, especially if you're new to investing, because the New Zealand market, to be fair, it's been languishing for quite some time. Whereas we've seen in the States, the S&P 500 and the likes, they've been going absolutely gangbusters. And that's why if you want to get exposure into those areas, using something like an ETF that is based in New Zealand can be a good starter for you. So obviously you do need to do your own research and make sure what your goals are, but that can be a great way to get started. So I hope it's helped for today. Sort of not too much to report, but just remember, if you do have any questions or if there is a share you would like me to review or anything like that, it doesn't have to be in the New Zealand market. I'm happy to do so, and we can give you some more education. So until Thursday, we will do a share and review. Take care.